hear that the Bank of England's Governor, Mark Carney, announced that the UK's interest rates will be cut for the first time since 2009. The decision comes as an attempt to stop Britain's vote to leave the EU from bringing the country into a recession. Lower interest rates aren't the only thing battling the Brexit fallout though, as Carney also announced an expansion of its quantitative easing scheme as well as a funding scheme for banks. But what are these measures, and are they enough to stop the prospect of another recession?
At its meeting yesterday, the MPC agreed an exceptional package of measures comprising, first, a 25 basis point reduction in bank rate to 0.25%, a new term funding scheme to reinforce the pass-through of that cut in bank rate to the borrowing rates actually faced by households and businesses, a new program of private sector asset purchases with up to £10 billion of UK corporate bonds, and a £60 billion expansion of gilt purchases.
As predicted, the Bank of England has cut interest rates in half to a new record low of 0.25%. The central bank has also boosted its quantitative easing programme by £60 billion. This takes the total from £375 to £435 billion. The bank will also buy £10 billion worth of corporate bonds and introduce a new scheme of up to £100 billion to encourage banks to lend to households and businesses. But just how will all of this stimulate the economy?
People can borrow more cheaply, and it means people who've got mortgages their repayments will go down, a little bit more disposable income that they can hopefully go out and spend in the economy. Secondly, with lower interest rates, companies are able to borrow more cheaply. Hence, you get growth, hopefully they earn more money, and they employ people and unemployment goes down. That's also good.
As for growth, the country has seen its biggest downgrade between quarterly inflation reports. For 2017, the Bank of England predicts growth to be just 0.8%, much smaller than its original prediction of 2.3%. Since Brexit, survey data has shown that the construction industry has slowed down and there has been a plunge in the services sector, a sector that makes over 70% of the economy.
These indicators have all fallen sharply, in most cases to levels last seen in the wake of the financial crisis, and in some cases to all-time lows. The MPC has been conservative in its interpretation of these data, producing a forecast stronger than historical relationships would have implied. Nonetheless, we expect aggregate demand to grow only a little over the next few quarters before picking up to rates below those projected in May.
Despite the survey data, some people were surprised by Mark Carney's announcements.
An expansion of the Bank of England's QE programme, which has effectively been on hold for the last 4 years. And that additional amount, £60 billion, if anything, perhaps a little bit disappointing. I saw figures out there of anywhere between 100 and 200 billion pounds of additional money. Bank of England isn't going to be delivering it.
For others, it was everything they expected.
It was very much expected. At least a rate cut was expected. They've arguably gone one step further by expanding QE as well, and obviously the funding for lending scheme being expanded as well. So they've over-delivered.
It seems that the central bank has thrown almost everything possible at reviving the economy. But if it doesn't work, where else is there left to go? Could interest rates drop even further?
The market currently seems to be thinking that yes, we've had this quarter-point rate cut today. However, we're going to see more. That's what the market's saying. I just had a quick look at the short sterling futures, and what they seem to be indicating is about a 40% chance of UK rates being cut to zero by year end.
These new measures have been made without the presence of any hard data as to how Brexit has affected the economy. Most of that data won't be available until September. Chancellor Philip Hammond has also said that the government won't be taking any action until the autumn, when they can make a measured decision. Brexit may have created uncertain territory, but one thing that is certain is that the British economy will remain under considerable pressure for the future. Kirsty Nicol for CCTV in London.